All right, guys, we are in a series with Todd Langford, the founder of Truth Concepts, and I've heard so many amazing things from you guys. Todd, you are a hit. I don't know if you know this, but you are a hit in the insurance space, and people are loving the calculators. And one of the things that we're committed to doing is reading people's feedback. And there's a lot of people that have insights and ahas, and this would be a very boring, uneducational content if we just read all the love comments that we got. But there are 2 comments on our latest video that we did talking about the life insurance performance of whole life versus a high yield savings accounts, bonds, and more. And there's 2 people that commented. One was a little bit more extreme, a little more up in our grill and face, and the other person was a little less like just asked a question. I think both questions are valid, and what I think would be awesome is for me to ask them to you and for us to just discuss it, because this is whether people are meeting with people in the field, this is really valuable for them to like understand like how you're answering questions like this. Or maybe there's someone that's actually has life insurance or thinking about life insurance for themselves. They're watching this video and this will be really help them gain clarity on, is permanent whole life insurance something that they should pursue or not? So any thoughts before I jump in and hit you with these questions?
No, let's go.
All right. So the first question is somebody who, well, I'll just read you the comment. He said, clearly shows how whole life insurance is a scam. $27,000 a year for holding your money and giving you a $1 million death policy is extremely expensive. What's not mentioned is that to get your cash value, you have to follow the life insurance company's rules and restrictions. This person also goes on to say, I have term insurance for $400 a year through Costco's Protective Life for $1.25 million death benefit. Don't let this sales pitch fool you into thinking a $1.8 thousand annual premium for term life insurance. And so what are your thoughts there? This might be news to you. You might not see yourself as a salesperson, Todd, but you hear things, all kinds of things on YouTube.
Well, and it's to be expected because the insurance industry has a bad rap, right? I mean, it's got a bad reputation, and it's because there have been people involved in the industry that have done some bad things, right? Some of that's deserved, and so people automatically go in that direction. And it's easier to do that than it is to look at the facts a lot of times and actually look at the math behind it. But, this opens up a bigger picture that I think is hard to understand sometimes. And so I'm going to kind of go through it with a little analogy and some other pieces before we get into some math around it. But term insurance and whole life insurance both have a death benefit, right? So that if you die, that pays out. The similarities pretty much end there. Okay, they're vastly different, and both of them are very useful tools, right? When they're put in place in the right order, in the right strategy. And so, I like to kind of compare them to a house and a tent as an example. If I've got a tent, it provides shelter. My house provides shelter, and the similarities pretty much stop there. But if we think about this, I couldn't just haul my house into the woods if I wanted to go camping, right? Yeah. My tent works well for that. And that tent is temporary. It's not going to last forever. I'm not going to be able to pass it on because it's not going to make it that long. And even inside of that area, there's all kinds of different levels of tents, right? We could have a really high-end tent that has a porch on the front of it and even has an additional bedroom inside of it. Or we could go as small as, I had a trip that I went on, a Boy Scout trip when I was in elementary school for 2 weeks into Colorado. And the only way in was hiking or by horseback. And we were hiking. And I certainly didn't want anything any heavier than what I had to carry because we also had food and everything else we had to carry for 2 weeks. And so I had a tube tent. It was $2 in those days. And all it was a tube of plastic that you run a rope through to tie to 2 trees to hold the top and use your sleeping bag to keep it wide at the bottom. And so it was just a triangle that you could wad up, throw in your pack and go on. Well, it was finished by the end of that trip, right? It wasn't going to last very long. And I threw it away. And so that is a low-level term insurance policy. And you think about term could be at any different area. One of the things that we looked at last time with the term insurance, I think it was like $1,100 premium, something like that, but that was convertible term insurance. In other words, it can be directly converted into whole life insurance without even an exam for health. It's guaranteed to be convertible. Whereas Costco insurance doesn't have that. There's nothing to convert into. They don't have a product that does that. And you can even get cheaper than that. What about your group term insurance? You don't pay anything for, right? And so it can come in all kinds of flavors based on what kind of benefits and additional pieces are there. And so trying to compare one to another without knowing, ages and other benefits, you just can't do that. There's one thing that's true that I learned from my mentor, Norman Baker, years and years ago, and that is there are no deals in the insurance industry. And what that means is not just life insurance, all insurance. If we look at property and casualty insurance, building insurance, there's different prices based on what we want that to cover. If we decide we're going to take the risk on flood and not put flood insurance on our building, it's going to be cheaper premium. And so that holds true with all insurance, including life insurance. It's just a factor of cost versus risk for the insurance company as to what it's going to cost. And we look at those extremes now between whole life insurance and term insurance. Well, term insurance has very little risk for the insurance company because it's designed to go away. It's going to go away once we get to a place where the likelihood of collecting on it gets higher.
Yeah.
But whole life insurance is guaranteed to pay out whether we outlive it or not. In other words, if we live past 120, we get paid on it even if we're still alive. And so it's going to pay out. It's guaranteed to be there when we die. And as such, that's more risk for the insurance company. It's going to have a higher premium, but it also builds an asset. And so think about that in terms of the tent and the house, right? My tent's very inexpensive, but all I get is shelter, and minimal shelter at that, right? No air conditioning, no running water, none of that. But in my house, I'm actually building an asset while I get a place to live.
Yeah.
Okay. Well, it's going to cost more to do that, or it's going to have a higher premium. And that's what happens. But I also end up with an asset that I can pass on, that I can borrow against, all kinds of other pieces.
Yeah. I have many thoughts here. Thought number one is no clue who this person is. Doesn't even have a first name or last name. So thanks for that. Number two is no idea how long the term is. Is it a 5-year term, 10-year term, 15-year term, 20-year term? Don't know how old you are, how healthy you are. And this person ultimately, I think, proves a point of what we're trying to say. If you remember back in the funding calculator, you're breaking down permanent whole life, and we're talking about the internal rate of return of the cash value, and we're factoring in things like taxes. Hypothetically, taxes could be higher or lower. We're factoring in things like fees. Fees could be higher or lower. And then we're also factoring in and this was at the very end, you're like, and let's, this has a death benefit component. If people remember back to the video, the initial death benefit was around $1 million, but near the end, it was over $2 million. Okay. So, we're just, it's just one of those, like, let's just put a 30-year period of time for the age, we want to be conservative. So we're maybe not going to be making a quote on like super preferred. And we're just proving a point of like, there's a cost to that permanent death benefit. And that cost is already factored in to the internal rate of return. And so there's a lot of things that are like, again, like people, it's always interesting to me that people can watch the video and get all super analytical. And maybe this person, if they can show us that they have a 30-year, and they maybe check all the boxes, maybe the criticism is instead of us, maybe we lower the premium, but like it's such a minor thing. And the whole idea is we're not trying to say that permanent life insurance is like the best way to protect your family over a short period of time. The purpose of the video was looking at how do we compare a whole life insurance compared to other assets as it relates to your rate of return. I don't know if you have thought processes there, but this is not even addressing the buy term and invested difference, which is interesting to me. They're just addressing the cost of protecting your family. And the purpose of the video wasn't even talking about that this is the most efficient way to protect your family over a short period of time.
Well, and how they're protected and to what degree and in what circumstances. I mean, there's all kinds of pieces, as you brought up, as to, what dictates how much that cost is. But what happens is it actually becomes pure cost, we hope,
Right.
on the term insurance side,
Yeah.
right?
Yeah. I
On the
hope.
term insurance, we hope that it's pure cost and that we don't collect on it, because the only way we can collect on it is if we die.
Yes.
And that's the difference with building an asset, our house or our whole life insurance policy on the other side. Is that's fine. We're going to collect on that because it's going to be there when we die out there a long time from now, rather than having to do it in the short haul. And as such, we're going to build that other asset that's going to compensate and make up for that cost.
What do you say, Todd, to the person that says, well, I should buy term and invest difference? There's actually nobody in the comment section that said that. Before I read the next comment, the next comment was around, putting your money in the market and borrowing against it. We're going to talk about that in a second. But what do you say to the person that says, okay, Todd, let me just use your numbers. Why don't I just buy term insurance and invest the difference? And I know that this is kind of repeating yourself, but I think people need to hear you say or answer this question more than once. How would you answer that if someone was like, okay, I get what you're saying. Why don't I just buy term insurance? Hopefully it never pays out, means I didn't die, but my investments will way outperform where my whole life insurance would be.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our Anet Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the asset, different setups and designs that we use. And then we have an Anet Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
Sure, and this is going to take a bigger look. We're going to have to bring in some extra pieces. And I think the number that was used there was, what about an account that averages 10%?
Yeah.
I think we used something higher before, but I think we should go into that and look at that piece. And it was interesting on the idea of that 10%. It was clear the individual said something to the effect of, and they average 10%. Even though there were ups and downs, their average is 10%. And, it's unfortunate that the media and the financial institution as a whole puts information out like that that's just very deceiving. How does the average person have the ability to be able to calculate what that really breaks down to in real dollars? And that's what we're going to do here. Let's look at how those ups and downs impact, because most of the time when people hear 10% as an average, they hear, I earn 10% every year. Even though it was up or down, the effect is I earn 10%, but that's not what they say. It's a 10% average, and there's a big difference, even if it averages 10%. And it just so happens that if we go back 35 years, we'll do this in just a minute, the S&P without dividends did 9.96. So it'll be a good comparison of how we can do that. But for right now, what I want to impress on is just how different averages can be from actuals. And I'm going to use a way exaggerated example. So don't say, oh, well, he's not using realistic numbers. I know I'm not using realistic numbers. I'm trying to get a point across so that we can understand why that happens when we get into the rest of the analysis. But I'm going to use an exaggerated example. And what if I was to guarantee you a 25% average rate of return? And that would be pretty enticing, right?
That'd be amazing. Sign me up.
Yeah. All right. But yet let's break that down and look how I could do that and not get hurt so bad on my end. So what I want to do here is I'm going to put in $100,000 today. And if I could do 25% average, I probably want to try to borrow money from other people and everywhere else too, right? But if we did that, and let's earn, so change it from fixed earnings rate to variable there, and let's put in 100% rate of return, and then the next year I'm going to lose 50%. Okay, so look at the bottom of that column, and we see our average of 25%, and that's the way averages are done. We add up all of the ups and downs and then divide it by the number of years. So in this case, 100 up minus 50 gets me back to 50, divided by 2 is 25%. But when we look at the actual numbers, look where we are. At the end of that second year, we're right back where we started. And if we look at the returns there at the top, we see our average rate of return of 25%, and yet our actual rate of return was 0. The other thing that's interesting here is we had 100% gain, but it only took a 50% loss to wipe out 100% gain. The downs really are hard to overcome. They have a bigger impact than most people think. And that's why our averages and our actuals are very, very different. And think about this scenario here. Okay, so we ended up at the end of 2 years right back where we started, even though I fulfilled my obligation of 25% average annual rate of return. If I got paid for doing that, if I got a commission of, say, 1.5 points for running this, and you had to pay taxes on this, you'd actually end up with less than $100,000, and we could still call it a 25% average rate of return. And that's what we're seeing in the marketplace.
Yeah, I mean, I think that's a great example, and maybe we can go through the historical example where the average rate of return was a little under 10%. But I think this person's question was, it seemed to them like instead of doing the whole life insurance, what if they put their money in index, that average with the ups and downs at 10%, and then they could borrow against, because some houses will let you be able to do that, and you're not necessarily able to borrow against 100% of your money in the market for obvious reasons because of volatility. But that's what they're like. Someone watches that and says, well, like, what if I just did that? I still get the tax benefits of borrowing against an asset. Well, it makes sense in their head, like from an efficiency standpoint, that would be better. And my initial thoughts, and I'll hand it over to you, is, well, number one, we're dealing with an apple and orange scenario. You would need to have other insurances in place if you wanted to do that properly. So this is like the buy term invest the difference on steroids. It's like you're buying term insurance, you're putting your rest of the money in the market, and then you're borrowing against that. And like that's ultimately what someone's essentially asking is like, why wouldn't you do that versus putting your money into an overfunded whole life insurance policy and then borrowing against that to invest? Like they see it as instead of my core asset earning 3.5 to maybe 5.5% internal rate of return, what if my asset could earn over 10? Now I know that you just said the average versus actual is different, but want to hear your thoughts, and I'll just hand it over to you to address that. My last thoughts is it's just a lot more risky of an approach, and I would love to see how many times that actually works out and how many times that actually fails.
Yeah. So we'll go into that. I mean, that's a big question, and it's going to take quite a bit to answer. And I want to think about something beforehand from a conceptual standpoint before we get into it. And really, so everybody wants to compare their greatest and best asset against the return on a life insurance policy. And the life insurance policy is really not an investment vehicle. It's a savings vehicle. It's that certainty asset. And so why the difference? And think about this. So when we have money in the market, as an example, if we're following modern portfolio theory, there's the idea that we have an offsetting certainty asset to help with those ups and downs that are happening on the equity side, right? And typically that vehicle is a bond. And so people don't have an issue carrying a 4% bond that may have a 1.5 management fee on it and having to pay taxes. So that bond's actually netting probably less than 1%. And yet they're using that as that certainty asset. Now, what we're saying with the life insurance is not necessarily, we're not trying to compete with what that equity side, with what that investment is. It's more the bond side. It's the cash side. And we can think about it the same way with real estate, right? Now, there are people that have gotten lucky with real estate, and those people typically aren't in for the long haul, okay? Long-term real estate people, as an example, have a lot of cash laying around. That's the only way they can survive in that world. What does that cash do? Well, the cash is there for those black swan events. When we see COVID, when we see other things that impact rents, when they impact all kinds of other things, storms that take a roof off. What do we do with that? We've got to have cash to keep from losing that whole asset. And so we lean on the cash assets, which are typically at 0%, 1%, something like that in a checking or savings account. It's those assets that we could actually use a life insurance policy to handle, and we'd have a way better rate of return. And it would still be in place for the opportunity side of that investment. So what happens with real estate investors when the market craters? That's actually a good thing for real estate investors, right? If they're in a position of cash. And that's another reason a lot of times they will hold cash to be able to take advantage of those times when that comes along. So what people want to do is say, well, life insurance policy doesn't perform as well as my 25% real estate. Well, no, it's not designed to do that. But what about all that cash you have laying around? That's where that life insurance policy really fits. Now, what's interesting is, though, when we look at the market, when we look at the equity side, and we look at returns, even though life insurance isn't designed to compete on that side, it's more for the bond component or that safety side, that certainty side, it actually performs just about as well as what we're going to see in the market without the risk side. And so we're going to look at that, but understand I don't particularly like that comparison.
Yep.
Because it's two totally different assets. It's our certainty asset compared to the return of our risky.
Yeah, nobody in the comments, by the way, was comparing to a high yield savings account or a bond long term. Just to be clear, like these are anyone that usually throws shade is someone that's talking about an investment to a life insurance, which is a savings or a protection vehicle. And I don't think we made any statements to say that this should replace any investments. In fact, if people watch this series, they will see that you're talking about life insurance with equities. So I'm, again, not speaking for you, Todd, but I definitely don't think you are anti any one asset class and all for life insurance, and that's the only asset that you should have. I think you've been pretty consistent about life insurance makes other assets larger in the presence of life insurance. I believe that's a quote. I probably butchered that, but it's a similar. It's the essence of the quote that you gave me.
Yeah, and see, and think about it for the individuals that go after the life insurance so often, and they talk about, well, I could do X in the market. We've seen it do, in excess of, 8% every year. I know I could do 10 or whatever else, but they don't talk about the fact, if you can do that, then why do you have money sitting in your checking account or your savings account? Yeah. Why wouldn't you have all that in the market? Well, it's clearly we can't live our lives like that, right? There's other things. We have to have that emergency opportunity fund, and that's where the life insurance cash value really has a great role. Yep. So, but let's look at it in that light just to answer that question so that we can see what happens. What do you think?
I think that's great. Okay.
So here what we see is, so if we look at that second column there, it's the S&P 500 with no dividends, and it just happens that it's 9.96% over the last 35 years. I didn't pick a particular time frame. I just pulled the last 35 years, so that we could get close to that commenter that said, about the 10%. And so we're going to copy those ups and downs, and we're going to look at it a couple of different ways. But what I want to look at first, if we pull up the accumulation calculator, I want to look at what that 9.96% does. And I'm going to do this based on, just to try to round numbers up, $10,000 a year. Okay? So if we put in $10,000 a year, and I want to put 9.96% over here. And what we see on that time frame is that would grow to $2.9 million. Okay, and so let's just keep a record of this over here on the side so that as we make changes, we can see what's happening. I'm going to actually leave this one in case we want to come back to it. And let's just duplicate this to another one and we'll make adjustments there. Now, like we saw earlier in our exaggerated examples of averages versus actuals, we see that if we earn the 9.96 that this averaged over that time frame, it would grow to $2.9 million. But what if we put the actual returns that averaged out to the 9.96. What does that mean? And so we're going to paste those actual ups and downs from the last 35 years. So it's not numbers I've made up. It's what happened in the S&P without dividends. And we can see at the bottom of that column, there's the average of 9.96. And look what happened to the return. It went to $1.8 million. So we lost over $1 million between the average happening every year and the actuals that made up that average over that time frame. And it's really a shocking piece. Every time I see this, it really amazes me that is that drastic of a difference. And so you would think what that would do is mean that the actual annual return was considerably less than 9.96. But if we turn on our rate of return and look what's going on up there at the top, what we're going to see is it actually only changed the yield by, in most people's minds, what they would call 2 points. That's just the difference between 9.96 and 7.97. And yet losing those 2 points, it's a lot more than 2 points, right? Because we lost about 30% of the account, actually over 30% of the account, by that drop there between 9.96 and an actual return of 7.97. So those ups and downs, why they average 9.96, they actually did the same as if we had earned 7.97 every single year. And this goes back to what we saw earlier on that exaggerated example of our 25% rate of return. The downs hurt more than the ups help.
Yeah, okay. And this even gives the benefit of the doubt of dollar cost averaging, this idea of buying and then getting the upside of market growth. And so if would you make the assumption, Todd, if you just had a lump sum, it would perform worse than us buying in throughout every year?
It depends. What's interesting is, so there's a couple of things that happen when we're doing this and we're putting money in every year, dollar cost averaging. Where those ups and downs occur is very impactful on what our end number comes out to be.
Got it. Yep.
If we only have a lump sum, it doesn't matter what order the ups and downs are. It's going to be the same number at the end of the time frame.
Yep. Makes sense.
So if our losses come late with dollar cost averaging, it really has a bigger impact.
Yep. Makes sense.
So now we can look at this 1.8, and again, because of the media, because of what's going on out there in the financial industry overall, and people talking about these big numbers, everybody has it in their head that it's just that 10% as an example. But we forget about all the other pieces. We forget about the ups and downs, or actually, that's something that nobody's ever even been taught for the most part. But what's also left out are the taxes and the management fees along the way. And so that's already included in our life insurance, as well as a death benefit on top of there. So if we wanted to compare those, even though that's not really the type of comparison, that's an investment with a savings vehicle, I want to do it just to put things in perspective a little bit. And so if we go ahead and add a management fee, and I'm just going to use 1.5 points, and that's also kind of interesting because we lost $600,000, but all that was paid out was $218,000. Mm-hmm. So the fund manager got $218,000, but we lost $600,000. And the reason is, unfortunately, every dollar that comes out, we lose that dollar plus any growth on it for the rest of the time frame. So it's way more impactful than even those flow of dollars going out, right? And then if we looked at taxes, and again, some of it's going to be capital gain, some of it's going to be regular income tax, we're going to have state tax in there. If we just select a 20% tax rate, just to try to simplify this, then, that took another $470,000 away, something like that. And so we end up with $818,000, even though, just like with the management fees, we only paid $235,000 out.
Yeah.
But the impact, because of loss of earnings opportunity that happens internally when we take those dollars out.
It's super interesting because now you're looking at an actual yield of 4.31%.
Right. And no death benefit.
And this is where again, Costco life insurance, type in those numbers. That's another factor that we're not even factoring in right now, is the permanent death or the death benefit.
Right. And we could do that. We could add the term insurance here and just say a $400 term insurance charge per year. And it's not, it's just going to impact what we end up with. And that would cut off, let's assume that's a 30-year. I don't know, like you say, we don't know how long that term insurance was. I doubt it was longer than 30 years. And if we cut it off in that 31st year, no more cost, but understand the death benefit goes away at that point. So we lose the death benefit when we stop having to pay the premium. And now we're down to 4.13%.
Yeah. And that's where, again, just to be very clear, life insurance is not an investment. The pitch is not, this is going to outperform investments. But the idea is we just took the S&P index, essentially, the last 35 years, and you created a scenario that's not too crazy, putting $10,000 a year, adding a fee, adding 20% taxes, adding a $400 term insurance cost, which is way under, we're just appealing
that is Tube 10 insurance, right?
Yeah, Tube 10, yeah. And now you're getting to a place where the rate of return, it arguably potentially could be less than what life insurance could be over the next 35 years.
Yeah. And here's what's interesting too, and I don't want to get into that, but when we look at life insurance, we're in a low dividend time right now. And so we're going to assume that it stayed right where it is right now and didn't have any upside potential, which if we went back 35 years would have a better return than what we're seeing today. Yeah. But we're just going to, life insurance illustrations are based on performance today and going out forward at a very low rate. And so even looking at that, I think we should kind of compare and just see how those two line up, including some death benefit. What do you think?
I think that's great. One thought as we transition over to there, it's interesting. We can't, in the last 35 years, say the average internal rate of return on a life insurance policy was X. So we're just going to factor that out. We're ultimately taking historically the lowest interest rate environment, but then we're having to compare it to the historical performance. And there's been the market's done amazing in the past, and we even have looked at even an amazing. There's downfalls to it, but it's just really interesting how there's contradictory areas of what we can say, what we can't say, but then most people, we don't know what the future is going to hold with where interest rates are at, where political areas at, where with all the money in the market, with people starting to take it out. We don't know if the next 35 years is even going to be the same, but yet it's common practice to just look back and make the assumption that that's something for future, which is just interesting.
Yep. It's really, again, two different comparisons. The excess of the market over the last 35 years to the minimals of what we're seeing right now going forward on the life insurance side, right? And yet it's still in the ballpark.
Yep.
All right. So let's use the funding calculator. And so here is a policy. It's the same policy that we used last time. I'm just using a reduced premium just to keep it at a level 10,000. So we see $380,000 of death benefit out here to the end, and it grows to $770,000 over this time frame. Now, what we just saw, it's the same policy that we did last time at $27,000. It's just a smaller one, so we can round that number to $10,000. We see $380,000 of death benefit initially, that grows over this time frame to $1.2 million. So we have an increasing death benefit. So think about that, our analogy earlier with our house and our tent. The term insurance is staying level, right? And so inflation is actually making that term insurance less and less valuable over time because it's staying level. With our whole life policy, we have an increasing death benefit, kind of like our asset of our house. As it grows over time, it's worth more and more. And that's what happens with our whole life insurance death benefit. So we have an increasing death benefit that we really can't compare to that level term insurance that's getting impacted by inflation and actually reducing in value. Over that same time frame, we also see that we have this cash value that grows to $770,000. So that death benefit column is a combination of death benefit and cash value. And so we see that we have $770,000 of cash over this time frame and an additional almost $500,000 in death benefit if death were to occur. Right? All right. So if we look at the return on this as it sits right now, what we see is 4.03%. And what we saw a minute ago on earning an average 10%, if we use the historical of what the S&P index has done, it was 4.13. So a little bit better, but we have the death benefit here that we don't have in that other example. So there's a little differential. But if we look at that accumulation calculator again for just a minute, rather than 770,000 that we see here, I think we had a little bit more. And it was 787,000. So about $17,000 more in cash, but we don't have the death benefit. So actually not a big difference even from a cash standpoint over that time frame, right? All right, so let's go back to our funding calculator and look at the life insurance values. And what I want to do is let's put those same returns on an alternate account and see what would happen if we shifted these dollars. We didn't go to life insurance, but we went to the other account, just so we can really kind of compare them side by side. And so if we turn on this alternate account and we turn on the alternate account over on the right, now then I'm going to paste in, if we turn off the fixed earnings rate, and actually let's do this. Let's put our 9.96 up there on the fixed earnings rate first. And at that average, this account would do substantially better than the life insurance if it could earn what that average was every single year. Unfortunately, that's not what it does. And so when we paste in our variable ups and downs across this time frame, we end up with this average of 9.96, just like we saw, but we actually end up with $1.8 million. And again, that's before taxes and before any commissions or fees on the earnings in our equities. So let's turn on those fees. And then let's also add 20% tax bracket. And so here's 779,000. Again, if we had term insurance, right? So let's pull it in.
Costco term insurance, $400.
Yeah, the Costco term insurance, $210, right? So we're going to pull that in, $380,000. So here's our term insurance, ends up with 751,000, both the account value and the value to the heirs, because what happens is that drops off the books when we stop paying our term insurance premiums over time, unlike what happens on the whole life insurance side. But again, you know, we've got a bunch of numbers thrown out here. It's hard to get your head around, well, what is going on here? So let's look at it from a graphical standpoint. And I think this will really, you know, bring it into focus. And turn off the legacy here. Just let's simplify and let's look at cash. So what we can see here, we spent the same amount of money in both scenarios. But what we have is this gold line here is actually the buy term, invest the difference strategy from a cash standpoint. And it's going to be ahead of the life insurance cash value on the front end, depending on what happens in the marketplace, and assuming that the life insurance stayed in this low dividend time from now on. So the equities has the advantage of the last 35 years of what happened, whereas the life insurance, again, is just at a fixed current dividend. But still, even at that, what we see is here when we cross over about age 53 there, actually the life insurance is higher than that equities account. And here's what's interesting when we get out here a little bit further. So we see that big spike, and this is the spike that happened 3 years ago, right? We saw this big jump, and the next year, which was last year or year before last, we had that drop, right? Well, the drop was only 19.4%. I mean, only 19. I mean, that's a lot, right? But
1/5 of your value. That's another way to say that.
our gain the next year was 24%, and the market will get credit for having a 24% gain, and yet it's short of where it was before the 19% drop. Again, it goes back to what happens, and those downs hurt more than the ups help, right? And we can see it right there. All right. So overall, they're actually pretty similar, except that we've got one curve that's actually smooth and steady and that we can kind of count on, whereas the other one, it's going to depend on where we are. You know, are we in an up year when we need the money, or are we in a down year? And if we're in a down year and we need to pull money, we can't make it up by having an up year after that. So we really lock in the losses if we have to pull money in the down year. So that could be a problem. Let's look at it on the legacy side instead of the cash.
Yeah. And the one thing I'll also say, if you're looking to lend against something or borrow against an asset, again, life insurance, you're comparing it to an investment, and it's comparing quite well, but they're apples and oranges.
Yeah.
And if you were even going to borrow against an asset, there's a reason why banks and insurance companies will lend almost dollar for dollar, about 90 to 95% of the cash value with no questions, versus if you had an equities market and you were going to lend against it, isn't it like 50% or 60%?
Yeah.
Because of the volatility. And so that there's other factors that are going to, like, maybe you even, in this scenario, it's even less, but even if it was more, how much more would it have to earn for you to have the same access to cash value that you have in the boring whole life insurance based on the access that you have to your money? That's another point that I don't want to derail you, but that's another point that I think of when it comes to comparing indexes versus life insurance when it comes to borrowing against it.
Yeah, I want to address that a little bit deeper here too in just a minute, so make sure that I come back to it.
Okay.
When we look at this, it's really kind of interesting too from a death benefit standpoint. See, again, we can't really compare term insurance to whole life insurance because we have that flat level asset that in this case, we can see where at age 64 it went away. So from the standpoint of what goes to the heirs, it's considerably less at the end as far as what we have created here to be able to use on the long term. So not only do we have pretty equivalent on the cash side, when we get to the death benefit side, it's considerably better with the whole life insurance versus the buy term invest the different strategy. Okay, so let's address what you were just talking about for just a minute. If we go back to our accumulation calculator for just a minute, so let's look at year 33, age 67. We see $673,000 there, and we see a gain that year of almost 27%, 26.89%, that grows that account to $819,000. So let's say we borrowed against this asset in that year, and we did it at our max 50% that we're allowed. So a little over $400,000, right? Now, what if we had what just happened and there was a loss of 19.44%? So now our value is $658,000. So half of that means we're really only entitled to $325,000, yet we have $400,000 borrowed. What's going to happen? We're going to have a margin call.
Yep.
We're going to have a margin call right there. And now what position are we going to be in? Because we're either going to have to liquidate the assets that hopefully we bought with that money that we borrowed, and it's liquid enough to be able to do that. But if it's tied up in real estate or somewhere else, what it might mean is we have to liquidate some of this asset to do it. And we're going to have to liquidate it in a down market, which is going to have a double bite because now it can't be fixed. And so while, yes, we can borrow against this, it goes back to what you said. It's at a much smaller ratio as far as what we can actually borrow and use. And it carries some additional risk because of those fluctuations that could hang us out to dry.
Yep. And if you wanted to buffer that risk, you'd have money having to sit somewhere safe. And our point is, if it's not going to be in life insurance, there's an opportunity cost long term of where that could be. And so I love that example. I didn't even think about if they margin call how you're going to pay that, most likely you're going to end up selling at the worst time to sell. My mind never went there, but it makes a lot of sense. And that's probably why the average investor is not earning anywhere near the average returns that the market gets. It's because of activities like this and then emotion.
Yeah. Well, even if you could, see, to me, you're going to have to make a lot more as an average in the marketplace to make it worth doing, because this individual that invested into the marketplace under pretty ideal scenario, 9.96%, but yet when you net it down to 4.13, what's tough to me about that is you had to earn, call it 10% average risk. You had to take on that kind of risk to still get only a 4% rate of return. I'd rather be in a safer asset if that's all I'm going to do on that upside in this case, right?
I love it. And I really appreciate you breaking this down. I know that some of this is repetitive, but even for me, like, loved you breaking down multiple calculators and walking through step by step and really building the case to the questions about buy term and invest difference, but then also the questions of why you may not want to just put all your eggs in the index S&P and then use that to become your own banker with the market. That may or may not turn out super well. And I think this example really proves the point to why you wouldn't want to do that.
Yeah. Well, and again, you know, it goes back to, I don't want to ever knock any asset or anything like that. They all have their purpose and their place. But it's the same thing with life insurance, always gets knocked for what it is. If it's the right strategy in the right place, it's the right tool. But it is a savings vehicle and not an investment vehicle, and we need to keep that square. We violated those rules a little bit here by comparing it to an investment asset. But really, it ought to be that bond component. It ought to be that safe component. It ought to be that emergency opportunity fund. You call it often an and asset. It's a place where we can go, but when an opportunity comes along, we can use it there too, because we have access to, like you said, 95% of that cash value to be able to go and do another deal.
All right, guys, keep those comments coming. Maybe if you're lucky and your comment's really good, you might even come on with Todd one of these days. We'll see. We have a lot of videos to shoot in this series, but excited just for all the people engaging. Thank you guys for sharing this. If you are an advisor, if you help clients, you help people with their money, and you want to use Truth Concepts as a tool, there's some really exciting things that are going to come down the pike later this year, and we have a link for you to learn more about Truth Concepts. And if you're someone that wants to just learn more about, should life insurance be something that I should look into and want to learn more, we also have resources for you that dive into all the numbers and more on the pros and cons on life insurance, and some of it being Todd's videos in that education path. Todd, is there anything else that you want to share as we wrap this video up?
No, I think one of the things I would, though, real just quickly, is don't be overwhelmed by what we've gone through. This is kind of, a lot of this is revelation to me of playing with the numbers and actually looking at them on a level playing field, not wanting to demonize any particular asset or hold one better than another. If we just look at the math behind them, I think we can kind of figure out how they fit, where they fit, and truly compare apples to apples.
Awesome.